Stick around, because some of these cities are already starting to slide. Mortgages now devour 60 to 70% of the average household's income. One global index ranks Miami the most at-risk housing bubble on Earth, with prices having jumped nearly 50% since 2019. But the heat isn't isolated. Los Angeles, Boston, Tampa, Detroit, Las Vegas, Atlanta, Charlotte, Cape Coral, Knoxville, and now Phoenix are all showing signs of the same dangerous pattern. In LA, buyers spend over half their paycheck on housing. In Detroit, homes are priced 40% above long-term value. In Phoenix, water shortages are threatening entire developments. What happens when not one or two, but 11 major U.S. markets buckle at once? Miami isn't just leading the global real estate bubble index. It's rewriting the definition of unsustainable growth. Since 2019, real home prices in Miami have surged nearly 50%, while median household income has crawled up by only a fraction of that pace. The result? Buyers are now spending between 60 and 70% of their income just to afford a basic mortgage. And that's before you even factor in insurance, costs which have exploded due to increasing climate risks. In parts of South Florida, annual premiums for home insurance have more than doubled, with some homeowners paying over $10,000 a year. In flood zones, many buyers are being outright denied coverage or forced into the state's last resort insurance pool, which only adds more volatility. What's worse, inventory is climbing, but prices are holding steady, for now. That's a classic bubble sign. Pressure is building silently. This is the calm before the fall, and when it cracks, it won't be a soft landing. Los Angeles is walking the same tightrope as Miami, just wearing designer sunglasses. Mortgage-to-income ratios are just as dangerous, exceeding 60% in many zip codes. But LA brings another twist. Sky-high housing prices paired with a crumbling affordability index. The median home price in LA hovers near $900,000, and that translates to mortgage payments well above $5,000 a month, even with 20% down. And it's not just million-dollar listings. In formerly middle-class neighborhoods like Eagle Rock and West Adams, sellers are now slashing prices after months of no activity. 1 in 3 homes listed in early 2025 saw price cuts. Bidding wars are disappearing, and time on market is extending fast. Meanwhile, insurance premiums are jumping in wildfire zones. California's insurance market is tightening, with major insurers like State Farm and Allstate scaling back coverage. In some hillside neighborhoods, it's almost impossible to get affordable coverage. So what you have is this: rising inventory, unaffordable monthly costs, retreating buyers, and insurers pulling out. It's a pressure cooker, and when the lid finally blows, it won't just be a drop. It could be a multi-billion-dollar wealth wipeout. And that's just the beginning. Next, we head to the East Coast, where Boston's market is flashing red in disguise. Many sellers are slashing prices after listings sit for weeks without offers. Since 2020, home prices have risen by nearly 30%, while wage growth has lagged far behind. The average home now costs over $800,000 in the metro area, pushing mortgage payments to unsustainable levels, over $4,800 a month for a standard 30-year fixed loan with 20% down. Mortgage burdens are crossing 60% of household income. That's a flashing red line for market stability. And Boston's slow-growth zoning laws aren't helping. New housing supply is nearly frozen, driving competition during boom times, but risking gridlock in downturns. If rates stay high or layoffs hit, Boston could swing from tight and expensive to overpriced and empty. Tampa was one of the biggest winners of the pandemic-era migration wave. But the glow is fading fast. The city is still recovering from the effects of 2008, but home prices have soared since 2020. But wages haven't followed. and neither has demand. Remote work relocations are slowing, and many buyers who moved from high-cost states are now cash-strapped, facing higher insurance costs and falling equity. Some homes have dropped $50,000 or more in value in under 6 months. Tampa's Florida boom may become a Florida bust. Detroit is the most overpriced housing market in the U.S. compared to its historical pricing trend, overvalued by more than 40%. That's despite having one of the weakest job markets of any major metro. Unemployment remains high, and wage growth has been minimal, with the average home now costing around $250,000 in an area where incomes barely support half that. The affordability math just doesn't work. Mortgage burdens here have crept up to 45 to 50% of income, well above the safe range. And while Detroit hasn't seen the investor frenzy that hit cities like Austin or Boise, its vulnerability lies in its weak fundamentals. If the auto sector slows or another recession hits, Detroit could be the first market to flip. Vegas has always been a boom or bust town, and right now, it's leaning toward bust. Prices here are about 35% overvalued based on long-term fundamentals. After skyrocketing 60% from 2020 to 2022, growth has stalled. Inventory is now surging. Homes that once sold in 3 days are sitting for over 40. In Detroit, the story isn't a bubble, it's a slow-motion reset. Thousands of units were bought by investors hoping to cash in on Airbnb profits. But with rising regulations, fewer bookings, and higher interest rates, many are selling off or bleeding cash. And then there's tourism. Vegas runs on it, but visitor numbers are softening. If hospitality jobs are cut and demand dips, housing prices could tumble fast, just like they did in 2008, when the market lost over 60% of its value. It's déjà vu with new players at the table. Detroit is the most overpriced market in the country relative to its long-term pricing trend. Prices are 40% overvalued. Atlanta has seen massive inward migration and price growth. But now, homes are 40% overvalued. New construction hasn't slowed enough. Wages haven't kept up. And mortgage burdens are now at 50 to 60% of income. It's a pressure cooker with no release valve. Charlotte, like Atlanta, was a pandemic winner. But today, it's over 35% overvalued. Builders are still pushing new supply, but demand is cooling. It's not crashing, but it's running out of momentum, and the affordability ceiling is getting lower every month. Cape Coral exploded during the pandemic housing rush, with home prices jumping over 60% from 2020 to 2022. Investors and retirees flocked in, turning it into one of Florida's hottest markets. But now, the correction has begun. Prices are down more than 10% from their peak, and nearly half of active listings are showing price cuts. Sellers who expected bidding wars are now holding open houses with barely any traffic. Many investors are underwater. Insurance costs have become a major barrier, especially in flood zones, where premiums are skyrocketing or coverage is being denied altogether. And unlike Miami, Cape Coral doesn't have a global luxury brand to fall back on. And in Knoxville, the slowdown has already begun. This is what a retreat looks like before it becomes a rout. Knoxville is often overlooked, but it may not stay that way. Since 2020, home prices here have jumped nearly 40%, far outpacing income growth. Many buyers were priced out of Nashville and turned to Knoxville as a fallback. That worked until interest rates rose. Now, monthly mortgage costs have climbed sharply. Inventory is starting to pile up, and buyers are stalling. Knoxville may not have the speculation volume of Phoenix or Vegas, but that's exactly what makes its situation more fragile. Phoenix was one of the biggest winners of the post-2020 housing surge. Prices skyrocketed over 60% in just 2 years as Californians, remote workers, and investors piled in. But that growth wasn't built to last. As of 2025, Phoenix is now overvalued by roughly 38% compared to its long-term pricing trend. Inventory has surged over 70% year over year. Half of all listings are showing price reductions, some of them by $40,000 or more. And the typical monthly mortgage payment for a median home now exceeds $3,500. That's pricing out most first-time buyers and draining affordability across the board. But there's a deeper risk brewing: water. Parts of Phoenix and Maricopa County are now facing legal restrictions on new developments due to groundwater shortages. The state has warned that there isn't enough water to support the next wave of suburban sprawl. And if developers can't build, demand will compress against frozen supply, and not in the way investors want. So Phoenix is facing a four-part squeeze: overbuilding, affordability collapse, rising interest rates, and environmental constraints. It's one of the first major metros where the housing crisis isn't just economic, it's ecological. When the water dries up, so does the growth narrative. And for Phoenix, that may already be underway. So where are we now? 11 cities, 11 red flags. From the beaches of Miami to the deserts of Phoenix, the same signs are echoing across the country. Mortgage payments eating up 60 to 70% of household income. Home prices 30 to 40% above long-term trend lines, and inventories quietly rising while bidding wars vanish. It's not just economic pressure, it's systemic strain. We're seeing inflated pricing in markets where local wages can't keep up. We're watching builders pump supply into areas where demand is drying up. We're seeing insurance companies back out of climate-prone zones. And in cities like Phoenix, the risk isn't just financial, it's environmental. Groundwater is vanishing, construction is pausing, growth is hitting a hard wall of natural limits. And in some of these markets, it's already breaking open. It often starts with a stall, a slow decline in showings, a subtle increase in price cuts, a growing number of listings that sit longer and longer until sellers give in. Some of these cities will glide down gently. Others might see sharp corrections of 10, 20, even 30%. But the idea that home prices only go up, that's already fading. And the biggest danger isn't the crash itself, it's being the last one holding the bag. If you're thinking of buying in one of these cities, this might not be the moment to act. If you already own, it may be time to ask some hard questions. And if you're an investor, watch the signs, because institutional players already are. They're not making headlines, but they're exiting quietly, shifting portfolios, pulling back from overexposed metros.